Welcome back to the Thea Podcast, where we talk with the brightest minds in the worlds of tech, finance, economics, and startups. Today, I'm speaking with Matt McClintock. He's the founder and executive managing director at the Bespoke Group, a US-based multifamily office serving Bitcoin pioneers, crypto innovators, and ultra-affluent clients worldwide. Matt, good to talk to you.
Joe, thanks. Happy to be here.
Absolutely. Well, thanks for taking my invite. Obviously, you have a very interesting business and you have a very interesting backstory. In the write-up that I was reading, that I was emailed, you transitioned from traditional estate planning to founding this multifamily office. So what inspired that transition? What was that journey like?
Yeah, So in the first part of 2017, my business partner and I started a estate planning boutique law firm. Um, just based on his history and my history, we very quickly we started working with ultra high net worth clients in the 50 million plus range. Um, so we had a lot of expertise in that. And in November of 2017, one of my friends, who's another estate planning attorney, reached out to me asking for my help on a large client matter. And it just so happened that that client had about $100 million worth of Bitcoin. And I didn't know anything about it. I didn't have any point of reference on Bitcoin in 2017. And I said, well, I don't know anything about it, but I'll be happy to kick ideas around and see what we can come up with. Started doing a lot of research on Bitcoin back in 2017, and it was not nearly the mature market that it has become now. There was the block size wars. We were just a couple years after Mount Gox, the Silk Road, all that kind of stuff, and so all the rocks I turned over, I didn't really like what I saw crawling out from under them, but I thought it was kind of an interesting opportunity to sit down and have a conversation. So I met with this attorney and with her potential client, and was able to ask a lot of really pointed questions to that person, and they just every question I asked, they had a cogent answer for. They were clear-eyed, clear-minded, non-prejudicial, very open-minded, and I thought this is really fascinating that there is an asset that somebody has a tremendous amount of wealth in, and nobody knows how to do structured planning for this asset. And it just kind of rubbed me the wrong way that there was this asset out there that nobody would touch. These people had talked to other estate planning attorneys, and none of them would just even take it seriously or have a meaningful conversation. So yeah, I fell in love with those clients and ended up doing a ton of work for those folks in 2017 and into the first part of 2018. And through the law firm engagement, they asked for a whole lot of other kind of more wealth management type services, family office type services that went beyond what law firms are typically set up to do. And so before long, we kind of accidentally became a family office for that first Bitcoin centimillionaire that we were working with. And then one client leads to the next, to the five more, to the 10 more. And before long, we had this cottage industry of estate planning law firm that was serving these clients with significant Bitcoin or other digital asset, positions. And those clients almost uniformly wanted much more comprehensive services from a family office perspective. And so we kind of carried on that way into the end of 2023. And some stuff I think will be perhaps ripe for conversation today. Going into the last part of 2023, we had a high conviction that the Bitcoin ETFs would be approved. We knew the Bitcoin block reward would be cut in half. We knew, we've been around long enough to know that stuff, and kind of had this prediction that those two things would lead to a spike in retail investor interest that would lead to media interest in Bitcoin and create a halo effect again over the crypto space, and that we would see a significant rise in the spot price of Bitcoin. And I mean, of course, to a certain degree past its prologue, and that's been true. I see your block clock is ticking over just under 92K right now. So we saw a huge opportunity to lean in on the family office space, especially for affluent Bitcoiners, and wound down the law firm as of August, so we could fully focus on Bespoke Group as a multifamily office serving these clients like you're talking about. Our clients are global. We have clients mostly in the United States. We've got a number of clients that are, spread across the oceans. Yeah, we're a fully SEC registered investment advisory arm that is a, comprehensive wealth strategy firm.
That's fantastic. And so what you're doing now grew out of the need for it. Structured planning at this scale for people with a lot of Bitcoin didn't exist, for one.
Right.
And then because of the demand that you saw as a result of that, you pivoted your business entirely into it.
Yeah, that's right. That's right. I mean, we went all in. Um, I've been all in on Bitcoin pretty much since I found it in 2017. And it got to the point where now it's become the like the raison d'etre for my company.
Fantastic. And so for you, obviously the launch of these ETFs brought an entirely new cohort of people into Bitcoin.
Mhm.
What has the interest been like, in terms of acquiring new clients? Have you seen, as Bitcoin's price has risen, have you seen a commensurate spike in the amount of clients that are interested in working with you?
Um, yeah, just because I would say yes, because so many other Bitcoiners now have a whole lot more wealth than they used to have, in a
Mhm.
fairly short period of time. And to be clear, we built around clients who already had made significant wealth in Bitcoin. Clients don't come to us who have traditional wealth looking to get into Bitcoin. Our clients made their wealth with that, and they need people to help think through strategic wealth transfer, tax mitigation, structuring wealth for the long term for families, and then investing in non-Bitcoin investments, ideally things that are not correlated to crypto, not correlated to Bitcoin, um, but that are consistent with that client's worldview. And so I would say yes, we have had a significant uptick in interest from potential clients and from the clients that we serve. And I think a lot of it probably is driven by just the increase in spot price on Bitcoin because people feel richer now than they used to.
Right, absolutely. And not just that, but even, yeah, like you said, existing people, existing high net worth individuals who've made their money and are now looking at Bitcoin. I know for a fact that the $100,000 mark is this mile marker for Bitcoin. In that, obviously, like you said, start of the year, you had this prediction that the ETFs had a high likelihood of approval. You saw the halving coming. You thought that it would be met with a huge spike in the price and a huge spike in media interest. And this 100K mark will do the exact same thing. And Bitcoin has been morphing into a global asset held on the balance sheets of nation states. But at 100K, that's true more so than ever. And so I'd wager that even more clients would be looking to get into it and coming to somebody like you for help with that. So one question I have, obviously, this is a podcast, but it's a podcast for a Bitcoin self-custody company. How do you assess custody solutions for your clients? They have a lot of Bitcoin. Eliminating single points of failure is probably pretty key to them. And so walk me through how you assess what custody solutions to go with to minimize counterparty risks, but also risks of human error, because self-custody is hugely prone to that.
Yeah, no doubt about it. Well, as a foundational point, I've been a huge fan of multi-sig ever since I understood how it works. I do think that the right custody solution probably occurs on a spectrum,
Mm-hmm.
depending on what problems you're trying to solve for and what priorities you have. And this, I don't mean for this to seem controversial, but I think the perspective is a bit nuanced. Um, I have what I'm about to describe is a spectrum of custody that I have for my own holdings.
Mm-hmm.
I've got some Bitcoin on a self-sovereign, self-custodial wallet that's on my phone that if you and I were to have pints somewhere and the brewery accepts Bitcoin, I could buy you a pint in sats. And so that's easy. But I don't keep anything more on there than if I were to get hit by a bus on the way home, my family is not devastated just because they can't get into that single sig device. So that's like, to my mind, that's where it starts, is the pleb level sats where we're just going to go buy each other a pint. Then single sig is fine. When I think of when the value of the holdings become more consequential, where it would be a real bummer if my family can't access my Bitcoin, it could be potentially economically devastating for my family to not be able to reach my Bitcoin, then multi-sig becomes the next natural step in that evolution. And so much of what I see from the perspective of multi-sig is when clients do not have federally taxable estates from an estate tax perspective. They We're going to probably get into some of the terminology around estate planning here if that's useful. But most clients, when they're thinking about transitioning their wealth either to a spouse or a partner or to kids or to other people that they care about, they think about either using a will or hopefully they use something like a revocable living trust. But they're using estate planning strategies that do not require them effectively to shift the value of an asset out of their estates from a tax perspective. So in the case of a revocable living trust, or in the case of just kind of family managed custody, multi-sig is brilliant. And I think Thea's got a great solution for it. I've seen your UI. It's a fabulous product. But again, here's where some of the nuance layers in as well. When you're dealing with massive stacks and you're dealing with, by which I mean tens of millions, hundreds of millions of dollars worth of wealth.
That's not Satoshis, everybody. That's dollars that he's talking about.
Yes. Yep. Yeah, that is like when you've got like 50 coins, 100 coins, 1,000 coins, 5,000 coins. Then my argument is, especially if you are a U.S. person, if you are subject to the tax laws of the United States, and if you want to make sure that the people who ultimately receive the wealth that you leave behind, whether that's fiat or Bitcoin or something else, you want to have guardrails around how those assets are managed. It requires a couple of different things. One, you have to shift the value of the assets out of your estate from a estate tax perspective. That means you have to transfer those assets into an irrevocable trust or some other type of structure that gets the value out of your estate during your lifetime. The second part of that is not only do you have to shift the assets away from you, you have to now constitute ownership in that new entity. So again, there's a whole bunch of different types of trust structures out there that we use here in the United States. But at the end of the day, an irrevocable trust that is designed to get the value out of your estate requires a trustee who then controls the assets inside that trust. And if the assets are Bitcoin, then I cannot create that trust and put that in a multi-sig where I can still control the quorum. The trustee has to be able to control the quorum in a multi-sig type of framework, or you go into a qualified custody type of framework with just a more elaborate strategy. So when you're dealing with massive bags of Bitcoins and you're trying to do some really sophisticated gift and estate tax planning with that, it requires more complexity, and multi-sig may or may not be the right solution depending on the type of structure.
Absolutely. 100%. It's different for everybody, right? Not just because of the amount of Bitcoin they own, but then what their family looks like, who they want to pass these assets onto. It's brilliant. On your asset management page, I was looking at this yesterday as I was prepping for this. One of the things that it says is drinking upstream from the herd. And you talk about tailoring portfolios specifically for clients, but also maintaining a cross-asset perspective. Talk to me a little bit about what role Bitcoin plays in a cross-asset portfolio, and when somebody comes to you, they have a lot of Bitcoin. How do you go about diversifying that and then adding other assets into it?
Yeah, such a great question. Um, Bitcoin, I mean, I know I'm preaching to the choir here, but Bitcoin is such an unusual asset. Sometimes it behaves risk on, sometimes it behaves risk off, sometimes it's an inflation hedge, sometimes it acts like a tech stock. It's a fascinating asset. But fundamentally, we believe that it's a hard asset. Like it's a generational hard asset. It has most of the features of gold, but better. It has most of the features of a hard currency, but better. But it's also, you know, challenging from a custodial perspective. Um, when we think of cross asset mix, we've got a portfolio that we talk about as a resilient portfolio, and Bitcoin plays a key role in that resilient portfolio. Um, we think that over time, Bitcoin just continues to, with the volatility, continue to creep upward in dollar denominated value, both driven by the scarcity and inherent finitude of Bitcoin and the increasing demand over time. And as well as something that I know you talk about a lot on Twitter, which is the continuing erosion of the purchasing power of the dollar. So you've got Bitcoin going this way, the dollar going that way, the price delta just gets bigger and bigger. And we see that Bitcoin plays a role in that delta. We also think that other assets like real estate, other assets like hard currencies, whether it's the Swiss franc, whether that's the Norwegian krone, other assets like that perform better than the US dollar become interesting considerations in a resilient type of portfolio. The clients that we are fortunate enough to work with do have some additional challenges when it comes to their Bitcoin. Most of the clients that we get to work with have had Bitcoin for a very long time, which, on the one hand, it's great because they have a whole lot of Bitcoins, and they've had it for a long, long time. So they've got tremendous amounts of balance sheet wealth. The downside is that from a capital gains tax perspective, their basis is so low that when they go to liquidate that Bitcoin, they have massive capital gains tax liability. So, the clients that we work with, they made their wealth in Bitcoin, but they're still Bitcoiners. They're still long Bitcoin. And so we don't want to get them in a forced sale position unless the client just wants to start liquidating out. So, whether we have opportunities to borrow against the Bitcoin in favorable terms and then take the borrowing and invest in non-Bitcoin correlated investments, that's one thing that we can look at. We are not a fan of leverage. We do have a few principles that guide how we structure portfolios and how we serve clients. One is we absolutely believe in liquidity. We don't believe in illiquid lockups. We don't have any proprietary private funds. We don't have any LPs that somebody can buy. We believe in assets and we believe in liquidity. Because of that, we believe in price transparency, which also means most of the investments that we invest in are going to be publicly traded. So you have immediate price oracles as to the underlying price of whatever it is that you own. And most importantly, we believe that every asset ought to be title held to the client, so that to the client or to a strategy for the client, like a trust or some other type of entity. And the reason that's important is that most asset managers, or a lot of asset managers at least, want to sell you a fund, take a 2 and 20 carry, you're illiquid, you're locked up, you have no price transparency, you might get a quarterly report, but the numbers are what the numbers want to be. And you usually have a limited partnership interest in somebody's partnership fund. We believe that if the market moves, you should be able to pivot quickly. You should always know what you own and how much it's worth. And we want to make sure that your assets are not on the balance sheet of any potential risk-taking financial institution. We want your assets to be bankruptcy remote. So if that custodian or provider were to become bankrupt, You're not standing in the line of creditors to Celsius or to FTX or to you name it, waiting for a distribution. Your assets are your assets, and you take them where you want.
Absolutely. No leverage, high liquidity, ample liquidity, price transparency, all fantastic truths to live by, not just for the people you're working with, but also for any investor that's listening to this, regardless of your risk tolerance. Particularly with things like Bitcoin, these things, as you said, Matt, they're multi-generational assets. You do not want to be putting these things up. You want to be buying and holding them and then figuring out other ways to diversify into other assets to protect and mitigate your downside. On the same page, you said that the past 2 decades are an anomaly for investors. Obviously, we had the dot-com bubble a little bit more than 2 decades ago. We had the GFC, and then we had what happened, what governments and central banks did post-COVID. Through all of that, global markets have completely structurally changed. How do you guide clients? And on the same page, you talk about extraordinary outcomes. How do you guide clients toward those extraordinary outcomes in this world of global central banks that move on a dime to pump markets full of new money in that world? How do you guide clients to those outcomes in this brand new world that we've seen emerge in the last 2 decades?
Yeah, I think it's a multifaceted answer to your question. We see we fundamentally believe that what assets you own are probably the least important part of the equation. We think, first of all, that how you own your assets and where your assets are owned, those two things are more important than what the assets actually are. And here's what I mean by that. You could have the best returns in the world, you could have the smartest investment advisors in the world, and you could get your 20%, 30%, whatever off of your investments. But if you haven't thought through questions around how to own, like what happens if my spouse divorces me and takes half of what we've built together? What happens if I get sued by a business partner, or if I have to file bankruptcy for whatever reason, or I injure somebody in a car accident and I get sued and I lose everything? Or what happens when I pass this on to my descendants and they're not ready for it and they squander it with bad decision making? If we haven't thought through those kind of how to own questions, all the returns in the world aren't going to outrun that type of loss, as well as the loss to taxes, tax erosion. But then we also think about where to own. I'm sitting here in Colorado. Colorado does not have very great asset protection laws. So if I were to get sued in Colorado and all my wealth is held in Colorado structures, they're not very well protected. And God help me if I'm in California or in some other jurisdiction that's much more friendly to creditors. But if I set up my structures to hold my wealth, if I've thought about how to own, and my where to own is in a place like Nevada or South Dakota or New Hampshire or the Cook Islands or the island of Nevis or some other jurisdiction that has much more protective laws, then I've got a much greater likelihood of preserving the wealth that I've built by thinking through how to own and where to own. Once we think about those things, then we talk about, okay, well, how do we make investments in a way that's intelligent, that is that takes into consideration the erosion of the US dollar in a zero or low interest rate environment like we had for the last 2 decades with the great money print. How do we then look at positioning assets with that in mind? And we again look at it globally. We look at it across asset classes, whether that's, again, precious metals, good old-fashioned, analog Bitcoin, as well as digital gold, and crypto assets, primarily Bitcoin, and harder currencies, and public equities, and to a certain degree, curated private investments that are not our private investments, but we can curate for other clients. And then the final element is more of a recursive function, and that is the why or the purpose behind somebody's wealth. Because what we've seen, I've been doing this, Bespoke is not that old of a company, but I've been doing this type of work for 25 years, one of the things that I've seen from the affluent clients that I've been able to work with during the course of my career, most of them aren't so focused on just making their huge balance sheet get bigger and bigger and bigger and bigger just for the sake of growing the balance sheet. Getting into what the money means for the wealth builder, what they want the money to mean for the people that they leave behind, how they want their beneficiaries to become better people as a result of the wealth that they built, and how these clients want to make the world a better place through philanthropy. That then guides every aspect of the planning cycle. It helps shape the strategies. It helps us determine what structures own the assets, and it helps inform their investment perspectives. Bitcoiners see the world differently, and they want to be responsible and kind of curious and creative in how they invest. And no greenwashed ESG type of portfolio is going to cut it, and nothing basic and off the shelf is going to work. So it just takes a lot of discovery and a lot of getting into the family's purpose to help shape these portfolios.
I love that last bit that you spoke about, particularly with purpose. It's when people think ultra high net worth, generally what they think the stereotype is some guy wearing a suit, big round belly, monocle, top hat, smoking a cigar, doesn't really care about much of anything as it pertains to leaving something behind that's better than when they left it. So it sounds like for most of your clients, your strategy, it's not just about finances. It's not just about finances, it's about legacy. So
Right.
how do you help clients craft strategies that align with their specific values and priorities and what they want to leave behind? Because that particularly intrigues me, because I love companies that put a focus on that rather than just the bottom line.
Yeah, I mean, we try to be really upfront about it from our very first contacts with the clients. In fact, I talk about it in conversations like this, and we try to have that be a thread, like a through line of everything that we do. The other archetype, aside from the monopoly guy that you're talking about, the other archetype is the classic Lambro, the crypto Lambro, who, it's all, number go up and, everything is mooning and whatever. And so, and I'll tell you, that's just not the reality that we see with our clients. A lot of our clients, again, our clients are not typically people in their 20s or 30s, but most of them are in their 40s to 50s. We've got some that are older than that, but they're at a station in life where they usually have kids, and our conversation says, okay, so you made a tremendous, especially with Bitcoiners. I mean, you made a tremendous amount of money in the last handful of years. I mean, if you have hundreds or thousands of Bitcoins, the vast majority of your wealth came about really in the last 5 or 6 years. Certainly, but just by definition, in the last 15 years.
Mm-hmm.
So, what does that mean? What drew you to Bitcoin in the first place? And questions like that start to pull on some threads about, okay, well, I really believe in some of the values behind Austrian economics. Okay, well, what is it about that? Well, I believe that currencies ought to be, I believe that your currency ought to stand for something. And whether it's an anti-war statement or a free market statement or whatever it is, like, pulling on those threads and saying, okay, well, what is it about Bitcoin that first drew you to it? And why are you still holding on to it after all this time? What's the story there? And then invariably, if they've got kids, you ask them about the kids and you say, okay, well, your kids are growing up in an environment that's very different than the environment that you grew up in. How do you think that the amount of wealth that you have now and the amount of wealth that you will probably someday pass on to your kids, how do you think that will give them a different experience than the experience you had as a kid growing up? And just let them sit with that. And then, okay, well, they said, geez, I didn't really think about that because most asset managers have never asked them those types of questions before. They said, well, gosh, I really don't want to just dump all this wealth in their laps. I want my kids to have some sense of adversity. I want my kids to have a chance to grow and strain and struggle a little bit. That doesn't mean I'm going to disinherit my kids, but how can I create an environment where the family wealth has some scaffolding around it so that as the kids grow, they're encouraged to grow and build their own thing, backstopped by the family, maybe aided by the family, but not just completely reliant on it. And then asking questions like, we even have in some of our intake documents, is faith important to you? Honestly, I don't really care what the answer is, but if it is, then let's find out about that. Let's dig in on it. We've got clients who are very conservative, Orthodox Christians. We've got clients who are Catholics. We've got clients who are Jewish. We've got clients who are whatever. And we just digging in on those questions. If their faith is important to them, or if a cause is important to them, or if they have an expression of faith that needs to be manifest through their planning, that tells us something. And then we have a fairly cheeky question that we ask from time to time, and that is, look, is there anything at all wrong with the world as you see it right now? And if the answer is yes, is there anything you want to do about it? And then that almost invariably says, yeah, let's, what's possible. And so we get into a lot of philanthropy conversations with our clients. Some of them do spend a whole lot of their Bitcoin wealth in their churches or in their within their faith institutions. That's funded by Bitcoin. We have clients who we have one client in particular who is deeply committed to women's rights, women's health issues, and trying to solve for some racial injustices that she perceives. And so she's poured about 40 million worth of Bitcoin into an operating foundation to really do very tactical, on the ground things, serving women who have been trafficked, other workers who have been trafficked, working on health issues, and investing in companies that are run by minorities that are solving interesting problems. So it's a fascinating journey for us because we get to serve clients in a very holistic way. They solved the number go up, reach escape velocity type of problem just by getting into Bitcoin early. A lot of them did, but now they say, this is not really what I thought I wanted. There's more to life than having a huge balance sheet and having all this wealth. How can I express that through philanthropy or through other causes? So we get to do a ton of really interesting stuff for clients like that.
That's fantastic. Yeah, no, everybody has different needs and different beliefs, and I particularly like that question you mentioned because it's a very pointed way of figuring out what's important to people. By asking them what's wrong in the world, their response is what they view as important because every response is different. So that's fantastic. I want to ask you a question about family dynamics. So one aspect of your service is estate planning support. How do you approach family dynamics and estate planning, particularly for multi-generational families? Older people, they may have children, they may have grandchildren as well. And how do you foster alignment among family members when talking about the plan for transferring that wealth?
Yeah, I mean, at the end of the day, our client is the wealth builder, but their family members are kind of constituents of the plan as well, and so we do have to be mindful of kind of not really balancing those interests, but because again, our interests are our clients' interests.
Exactly.
But making sure that we foster an environment of open communication and clarity in the planning. Some of our clients just don't want to disclose even the level of their wealth to their family members, let alone what they've done with it from a structuring perspective. Others want their family members to be actively involved in sharing the decision making. It's a matter of just continually having conversations with clients about, first of all, what do they want this wealth to mean, and making sure that is properly structured so that the estate planning strategies and everything that we do for them is aligned around that value, what they want this wealth to mean. Then the conversation becomes, how do we then convey that meaning to the recipients of that wealth? And in the case of philanthropy, it's actively working with the charities on the receiving end to say, okay, this is the vision of the benefactor, and this is what they want this wealth to be used for. And in most cases, no, you can't talk to them. We are your intermediary. These people are anonymous. You will never know their names, but this is what they want. Can you make that happen? And so will often serve directly as the intermediary between a benefactor and the ultimate recipient. When it comes to family members, every client situation is different. We have one client who they've decided that their children have plenty of wealth on their own, and they don't need to receive the inheritance from this, from the private family wealth. That's a very difficult conversation to help them understand. Look, your parents want to make the world a better place. They want to give you and your children a better world to live in. Economically, you have more than you will ever need. They want to help you grow into a world that is a better world for you to raise your family in. And so having conversations like that, whether it's in a quarterly conversation, an annual conversation, but having facilitated discussions about, again, to the level of the client's comfort, walking the family through how the strategies work, why they were designed that way, what their expectations should be, just having open conversation. To the extent possible, we don't want beneficiaries to have surprises down the road, because those seldom end well.
Yeah, absolutely. I want to go back to something you had mentioned about different jurisdictions, particularly with estate planning. How do you help clients navigate those complexities with multi-jurisdictional estate planning, like having assets that are held out of where you are domiciled, right? And are there specific jurisdictions that you recommend more often than not? Not just for that, but also for, tax efficiency, privacy, and other considerations?
Yeah. Um, so we're educators at heart. We want clients to make sure that they fully understand the impact and consequence of any decision that they make. And when we talk about estate planning, whether we're talking about limited liability companies or foundations or other corporate entities, or whether we're talking about various types of trusts, not only do we talk a lot about the various design elements of each of those particular strategies, a revocable trust versus irrevocable, different types of tax structures, but we also do, to your point, talk a lot about jurisdictions. And depending on where the client is, odds are they don't live in a jurisdiction that is particularly favorable from a privacy or asset protection perspective. Within the United States, you basically have two types of jurisdictions. And one type of jurisdiction is the type that is prevalent where, frankly, most people live. It's prevalent on the coasts. It's prevalent in the mountains. It's prevalent, in the big cities. And that is a much more it's kind of more of a creditor-friendly type of construct when it comes to types of trusts. It makes it easier for creditors to reach into the trust. It makes it easier for beneficiaries to get access to information from the trust, even if the person who built the wealth and created the trust doesn't want them to have that access. That is, I would say, the prevailing ethos of a lot of trust laws in the United States. However, the other ethos it's actually a more old-fashioned ethos, and that is one that says that we really care most about what the creator of this wealth wants to do with this wealth. And so we'll make the structures more private. We'll make the assets more insulated from the claims of potential creditors. We will allow these structures to last a longer period of time. And so, most clients don't live in the jurisdictions that are most favorable. But there are states like Nevada, which has got excellent trust laws. South Dakota, excellent trust laws and very good limited liability company laws. Wyoming, probably the best limited liability company jurisdiction in the country, if not the world. probably not the world actually, but probably the best in the country, and quite good trust laws. Tennessee, great trust laws. Ohio, surprisingly, good trust laws. New Hampshire. I mean, there's a litany of jurisdictions that have made it a legislative priority to attract trust business, and by doing so, they create more protective trust jurisdictions or trust laws. Um, but then, some clients have a global footprint, and so they want to have access to non-U.S. banking. They want to have access to non-U.S. custody of various assets. Well, sometimes it's difficult to get a U.S. domestic entity onboarded with a non-U.S. custodian. So then we might look at things like Nevis or Liechtenstein or Switzerland or the Cook Islands or some other non-U.S. jurisdiction to provide better access to non-U.S. custodians. And it just so happens that some of those other non-U.S. jurisdictions also have very private, very protective laws that further insulate the wealth from the claims of potential creditors. You mentioned taxes in particular, and there's so much confusion, I think, and a lot of noise around tax planning in the crypto space specifically, but even more broadly, just among the affluent community. The buzzkill is that if you are a U.S. taxpayer, which means you're a citizen, no matter where you live in the world, if you're a U.S. citizen, no matter where you live in the world, or if you're a long-term green card holder, guess what? You're a U.S. taxpayer. That means that you'll be subject to U.S. federal income tax on your worldwide income, and you will be subject to federal gift or estate tax on the value of your worldwide assets. The government doesn't care if your assets are structured through the Cayman Islands or through whatever. If you are a U.S. taxpayer, then you are subject to income tax on your income wherever the assets are in the world. And yeah, you may have some treaty offsets or something like that. And you can do a lot of planning around the margins, but you're not going to avoid federal income tax. However, you can, as you get into philanthropy, there are a lot of charitable strategies that incentivize philanthropy by giving you fairly generous charitable deductions for various strategies. So whether you make an outright gift or whether you make a gift through a type of charitable trust that can provide some economic benefits back to you, you can still do a lot of charitable planning with wealth structures that can reduce your federal income tax load. And if you happen to be unfortunate enough to live in a jurisdiction with high state income tax, there are some structures that you can deploy that will allow you to avoid or at least defer state level income tax, even if you don't defer the federal income tax. So if you happen to be in Massachusetts, for example, and you're ultra rich, you're subject to up to 9% income tax on your state income. So
I have one of those attributes, but not the other. I am in Massachusetts, but not ultra rich yet.
Okay, well, then before you become ultra rich, Joe, get the hell out of Massachusetts.
Yeah, that's step number one.
Yeah, you get out of Taxachusetts. But because Taxachusetts also has a state estate tax that kicks in around $2 million, up to about 16% on the amount on the wealth above that. But Massachusetts has a millionaire surtax. So if you have income over $1 million, and maybe it's not like W-2 income, maybe you have a bunch of Bitcoin and you sell it, and maybe you were an early miner or you just bought it early or whatever, and now Bitcoin is ticking around 92,000 and something. Now you've got all this capital gains. Say, holy cow, I want to cash in on this deal. Well, guess what? If to the extent your income on that is above $1 million, Massachusetts will take 9% of that. Thank you very much. And that's on top of the federal. But if you plan in advance and you set up a very specific type of trust that then establishes tax residency in a different state, in a state like New Hampshire or a state like Tennessee or Wyoming or some other state that has no state level income tax, it is possible to set up that type of trust so that when you have an income event like that sale of Bitcoin, you still pay federal. You didn't get out of that, but you can avoid state in some cases. So, depending a lot of the structuring conversation, the estate planning, how do you own your assets? It just takes a ton of discovery around where do you live, what do you want to do, how much is at stake, what's your exit path, and then helping clients understand the cost benefit analysis of various strategies. If at the end of the day the juice is not worth the squeeze, don't do it. But if these things are your priorities and you have to have certain structures in place to achieve those priorities, understand what you're getting into, what the trade-offs are, and then you can become an informed consumer and make your decision. And because we're not a law firm, we kind of have no skin in the game. We don't care what strategy you do or don't engage in. We can advise you on that. And if you want, we can hook you up with some colleagues of ours that can do that, but that's between you and them. We have no skin in the game as far as what strategies you do or don't do. At the end of the day, we want to be a family office advisor, a strategist, working with these families long term and helping them build a family legacy, to use your word, beyond the numbers on the balance sheet, but help them shepherd that wealth through their lives and into future generations. That's the game that we're.
Fantastic. Well, thank you for the overview. Well, for any ultra high net worth individuals right now listening, perhaps right on X, any other listening platform, you now have an extremely comprehensive overview of why Bespoke may be the solution for you to get a family office set up and actually have them help you with that. Matt, before we go, and again, thank you so much for coming on. Before we go, what's your vision for the Bespoke Group in the next 5 to 10 years as Bitcoin matures, as the financial products sitting atop Bitcoin matures, the types of entities that are holding Bitcoin change and evolve? What's your vision over the next half decade and decade for your business?
Yeah, thank you. That's a great question. It's one that we spend a lot of time thinking through, frankly. To be quite honest, our ideal client is the client whose total family wealth is 100 million plus. And that's where we probably do our best work, our most comprehensive work. That said, we know that there are a lot of services that we can offer to clients that don't have wealth at that magnitude. And so a lot of what we're working on now and where we see ourselves growing in 2025 and beyond, kind of the next 4, 5, 6 years, is really developing our core family office solution around the ultra high net worth clients that provides them the level of attention and the level of tailorability of a single family office, but with the efficiency and creativity of a multifamily group. Most single family, most clients who are in the 100 to call it $950 million range, so the centimillionaire cohort, if they're building a single family office, first of all, they're probably going to be spending $2 to $5 million just a year getting that up and running. Their payroll is through the roof. They can't really afford to get the very best in class of talent, and then they become kind of constrained and somewhat inflexible. And so once you're in the $1 billion range, you can afford to hire pretty much whoever you want to. But in that centimillionaire cohort, they want geopolitical and macroeconomic analysis, but they're not going to go hire somebody who can do that. They want really advanced estate planning, strategy, design, and support and project management for them. They're not going to find that in a small single family office. They want access to non-US banking. They want to open Swiss bank accounts. They want to have access to hard assets. They want to have structured custody around digital assets. And they're not going to have that in a single family office unless you're really building something at scale. And we're building that at scale. We have already built that at scale in the wrapper of a multifamily office. And so we want to provide the kind of service that you could ordinarily only get in a single family office, but in an environment that is much more scalable in the multifamily office world. The Bitcoin space is maturing, and it's maturing rapidly. And I'm not really just talking about price appreciation. Bitcoiners are getting older. Bitcoiners are having families. Um, some of my Bitcoin clients are in their late 80s because they were mining as faculty at Berkeley or MIT. Um, so these wealth transfer conversations are very, very real. Um, we want to normalize Bitcoin as a topic of normal conversation in the family office context. That's what we are built around, and that's what we're equipped for. And we want to really elevate that level of conversation in the broader wealth management space.
Fantastic. Well, if there's any company that's extremely well positioned for it based on our conversation today, I think it's Bespoke Group. Matt McClintock, thanks again so much for coming on the show. Before we sign off here, where do you want to send people to learn more about yourself and your company?
Yeah, I think the best place to send people would be our company's webpage, which is just www.bespokegroup.io. I'm also intermittently on Twitter. I follow Joe Consorti, but my handle there is at McClintock_M. I'm also on Noster, just at McClintock, and I'm on LinkedIn because that's just somehow can't seem to escape that gravitational pull. So if you search for me on LinkedIn, if you find a Matt McClintock associated with Bespoke Group, that's me.
All right. Excellent. Well, thanks again, Matt. Great to talk to you face to face, and we'll talk soon.
Thank you, Joe. Appreciate the opportunity.